Hello guys, it's Dayo again with another video. So today we are going to be talking about liquidity. So we spoke about we learned about supply and demand in our previous video. So we are now going to be talking about liquidity. What is liquidity and what does liquidity do for the market? What are we going to be what is referred to as liquidity? You get so um liquidity is just practically money. Liquidity is practically money. Is your money. Liquidity is your money, the money the market takes from you. So liquidity is represented into different parts on the charts. It can be referred as inducement liquidity. It can refer to as a lot of things, but liquidity is practically the market collecting money from you. That's money that you get liquidated anytime you enter the market, and it hits your stop loss. So it's just practically stop loss. So now there are different types of liquidity. There are different types of liquidity or inducements. So the first type of inducement or liquidity that we are going to be looking at is our excuse me. The first type of inducement liquidity we are going to be looking at is our let's say we're going to be first looking at our trend line liquidity. So we have trend line liquidity, which is, as we all know, the trend line, as the name implies. As the name implies. Trend line liquidity. So trend line liquidity is the type of liquidity that induces retail traders to either buying or selling before it goes to the opposite direction. So this is the type of liquidity in which, when you see that the market is going in an uptrend and you tend to enter, not knowing that the market is setting a trap for you to enter before it breaks the trend line and goes to the downside. So it happens whether it's on in an uptrend or in a downtrend. So this is what we refer to as inducement trend line liquidity. Trend line liquidity. And the second liquidity we have is the support and resistance liquidity. The support and resistance liquidity for those kind of traders that are trading support and resistance. This is a trap. Liquidity is practically a trap to trap your money and separate you from your money. So it's just like the trap of the market towards retail traders. So since the market are aware of this trading method, they set to put a trap. They tend to set a trap for set a trap for all those types of trading style that you guys are doing. So when you tend to plot your support and resistance or your supply and demand trend line, the market just decides to surprise you and take you out. It can either take you out from here or take you out from here. It can either take you out from here, from the upside, or take you out from the downside. So this is the second liquidity. And the third liquidity is what we call the equal lows or equal highs. The equal lows or equal highs, or we can also refer to it as the double top and double bottom. So for those people that are into chart patterns, you might be able to recall this kind of name. You can you'll be able to recall this name, the double top and the double bottom. So the market tends to take you out from this kind of can decide to take you out from this kind of pattern. So it can just say, okay, since you're expecting the market to uh, go from this what are they calling it, neckline. Some people might just decide to say, okay, they are going to be taking their buys from here. When it reaches the neckline, the market may just decide to say, okay, let me induce them, I'll just come here and then go to the downside. And again, there's another way the market might decide to do. It might decide to as it has created an equal high or a double top, it will just, after creating the double top, it will just do like it's going to sell. So just do like it's going to sell, then takes you out of the market. So these are all traps. There are a lot of traps. We will see them as the time goes by, but these are the major traps of the market. These are inducements of the market. We can also just add an additional example. This is, for instance, the market is going in an uptrend, then the market comes and takes these low out. After it takes this low out, you see, the market has changed character. Let's start taking our sells. So the market will do like it wants to take the sell from here, then it taps into this place and continues going to the upside. So this is another trap. So you guys should be very careful of this. This is practically the method in which the market traps buyers or sellers. So yes, if you have any question, you can drop it down in the comment section or drop it down in the class. I'm going to be answering you guys. Thank you guys for watching, and I'll see you in the next class.